Hey everybody, welcome to the show. Thanks for stopping into the Every Money channel. Seth and Paul are here with you as always, delivering updated stock news. And we're going over a company that we've got a lot of requests for these past couple weeks, Infosys, an exciting Infosys. I asked Paul, is this Infosys? Well, we're going with Infosys. Thanks for joining us. This is an India company. Online it says it's a multinational corporation that provides consulting, business consulting, technology, and outsourcing services. We didn't know much about this.
It was founded the year we were born, Seth.
How nice. You and I, 81?
81.
How nice. What we're going to do in this episode is pretty exciting stock. We're getting a lot of questions about it. We thought we'd go into it in detail. So we appreciate you stopping by the Everything Money channel. Paul's going to go over it right now.
In detail.
My dearest Paul Gabriel, we're going to use our 8 pillars of stock analysis to look at Infosys right now. Let's go, baby. You want to start?
Let's do it.
What is the market cap of this company?
So market cap is $63 billion. So remember, everyone, we look at market cap as the price of the company. We don't care about the price per share yet, or probably ever, except for a reference. We basically don't care. So $63 billion market cap, which means if you bought every single share on the market, that's what it would pay. That's what it would cost you to own all the shares in the market.
So right now, this number really doesn't mean much, but we'll come back to it at the end of our pillars. Let's go.
Correct.
Pillar number 2 is PE ratio less than 20. Why do you like 20, Paul, for PE? This is price.
So great. First off, it's 26, so that's an X. The historical average of PEs in the market is 15 or 16. I like 20 only because I want to allow a little bit. I don't only buy cheap companies. I want to buy companies that have better growth potential. You should be willing to pay more money for companies that have higher growth potential. This is a difference between Ben Graham type investing and a Philip Fisher type investing. Philip Fisher was the kind of guy who came out and said, listen, value companies aren't just ones that are selling $100 worth of assets for 50 cents. It could be a company that has a lot of growth potential that's not being factored in. So it's kind of a mix of the two. I want to keep less than 20, just kind of have an idea of like, hey, listen, if it's 18, 19, no big deal. You start to get above 20, you really have to start getting a much higher rate of growth to be able to justify that. So still an X right now on 26. Again, it's not the be all and end all. It's just a way of factoring things in.
Let's go back for our new viewers, Paul. Why did you not go instantly to the stock quote and look at the price?
Stock price, guys, is merely a reference of how much they're splitting the company up in terms of price per little share. If a company is worth $1 million, has one share, the share is $1 million. If it has 10 shares, each share is 100,000. They're both still worth $1 million. Okay, and Rohan, maybe you can put that up when we sit there and describe that. But there's still what you care about is how many shares multiplied by the share price.
Rohan is our glorious editor in India. We love him and we love using him. Tweaky Tales. Go to Tweaky Tales. That's his company. Paul, let's go. Pillar number 2 is profit margin. We want to look at their profit margin.
19.72%.
That's pretty good.
That is a check. Software IT companies tend to have a higher profit margin. And just to look at the last 12 months, just to verify, $2.4 billion in net income on 12.8. So it's around that 19%. So we're still at a check and an X right now as of this very second.
How about revenue growth? Pillar number 3 is revenue growth over the last 5 years.
So where are we going to go for revenue growth? We're going to go to the income statement.
Okay. And Paul, real quick, if people don't have Y charts, where can they find this info?
You can find this anywhere. Yahoo Finance, Google Finance. Here's the great thing, though. We are creating an app.
Tell them
it
about
has started.
Go on, Paul.
The development has started for our app, where this will all be available for you for a small monthly fee to be able to get the 8 pillars and the financials on these companies, okay?
So we're going to tease this for a while, folks. We're developing our Patreon page. If as a member, you'll not only get more exclusive access to Paul's mind, questions, a Discord channel to discuss everything you want. We're going to have sit-down, uncensored Paul and Seth show, nightly shows a month for our elite Patreon members. But the app is going to be included as a part of Patreon when we get that cooking. So great things to come moving forward. Keep going, Paul.
And if you like the idea of the Patreon or what we're doing,
please make sure you smash that like button right now on the bottom.
It's and right subscribe.
Make sure you subscribe. Listen, guys. Paul said it best. Paul is giving all this information away for free. The Y charts cost him money. The app's going to cost $30,000 a year.
Oh, no. It's going to be just the data for the app is going to be $30,000 a year.
All we're asking, we're not asking anything from you as a viewer. Just make YouTube pay us so we can do all this amazing stuff by clicking the like and subscribe. We love you. Thanks so much. Keep going, Paul.
Obviously, the app will cost money too. All right, so revenue.
Revenue growth.
9.5.
Pillar number 3, revenue growth.
9.5, 10.2, 10.9, 11.8, 12.8. Check mark.
Now, why do you have to make like butt cheeks? You've never done that before.
I just thought I'd
you just made
show
2 sets
people
of butt
the progress we're making here.
Okay.
But there is definitely increases. And the great news is, these increases aren't so large where I'd sit there. I always get worried when there's a large increase, like $8 billion to $12 billion on a big company. I worry about acquisitions being part of their growth. It doesn't appear to be that case here. We'll know better when we go to the cash flow statement, but I like this a lot. So right now, another check mark there. So we have 2 check marks and an X.
Let's go to pillar number 4 is profit growth over the last 5 years.
Okay, ready? Should I do the butt cheeks?
No,
2.05 to 2.15, 2.5, 2.2, 2.3. Still a check mark, even though it's fallen a little bit from 2 years ago. But you look at the other 5 years, this is a very consistent profit company. I like that a lot. They just consistently make money.
Good stuff. Let's do pillar number 5 is number of shares. Shares of the stock that are outstanding, want that to be decreasing over time.
I mean, they've had pretty much the same number of shares, decreasing, check mark again. So they had 4.6 billion, now they have 4.25 billion. So pretty good.
Pillar number 6 is current assets greater than current liabilities, Paul.
So what is this? Total current assets?
Tell me. I'm confused.
It's basically cash on hand being more than the bills that are due in the next year. I always look at it and say, listen, just like you at home, if you had $1,000 in bank account and you have bills amounting to $2,000 that are due very soon, you're going to have problems, right? So I like to make sure that it's that the cash on hand is more than the bills that are currently due. So we go to the quarter for the most recent data. This company has $7.8 billion in cash essentially, right? Now that'd be cash or cash equivalents. But for all intents and purposes, right now, just call it cash in their pocket.
7.8 bill.
7.8 billion. Current liabilities, 2.8. But here's even better.
This is good stuff, Paul.
Not only that, their total liabilities is 3.6. So this is the mother effing checkmark city. So this is like, guys, if you're at home,
go on,
and you have $100,000 in your bank account.
I love when you do this. Keep going.
And you owe less than $100,000 on all your cars, your houses, your credit cards, student loans, everything. Are you going to go bankrupt?
You're doing great. You're sitting
It'd
great.
be very difficult to go bankrupt. This is a very rare thing, guys, when the total current assets, the cash on hand, can pay off all the debts. Now, here's the other thing.
Go on.
There's $4 billion in extra cash there.
Oh, I know where you're going with this.
Which means you have to decrease the value of the company by $4 billion on the market cap, because if you bought the company today,
$63 billion,
you'd actually get $4 billion in extra cash in your pocket. So you're essentially paying $59 billion for the company. So now the PE is no longer 26, maybe it's 23 or 24. Still above 20, but the whole point is that's a very good sign.
Your favorite one is pillar number 7 is free cash flow growth.
Okay. Well, the free cash flow metric in general, I like a lot.
Why is that?
Because free cash flow is what the company uses to pay dividends, to make acquisitions.
So you've educated me on this, which I don't know if you're watching and maybe you didn't know. Is like I thought dividends were set in stone, but obviously if their free cash flow goes down, they can't pay those, right?
Correct. Like I just looked at Kroger today with Mo upstairs. I like Kroger until I saw that every single dollar of the free cash flow is going to pay the dividend. And that bothers me. All it takes is, and their margin is only 1.9%. So I was like, you know what? Even though Kroger is selling at a price that my analysis says I should pay for it, I sat there and said, I just don't like the fact that it's so tight there. But anyways, free cash flow.
Yeah, free cash flow growth.
So,
let's do it.
How do we do free cash flow, Seth?
Well, this is cash from operations.
Less.
Capital expenditures.
Correct.
What are you doing right now?
I'm subtracting these. Cash from operations less capital expenditures. 1.4 to 1.6, 1.9, 1.9, 2.2. Chickadee freaking check.
What are you burping up right now?
I know. I had lunch early because we decided to do that.
Yes.
So I ate Indian food.
Oh boy. No pun intended. This is an Indian company. All of this adds to 9, by the way.
Oh, yeah, you're right. Okay, so now here's the thing, guys. Here's the metric. 9 divided by 5 equals 1.8 times 20, 36 billion.
Wow.
Okay, so.
Whoa. Slow down now.
We're going to.
Tell them what you did there.
What I'm doing here, guys, is when I look at free cash flow, if there's a lot of growth in free cash flow, which there is here, they've increased their free cash flow by over 50% in the last 5 years. I want to take an average of the last 5 years and multiply by a certain number. What is that number? You can make it whatever you want, and it changes based on the situation. If the cash flow is decreasing, you want the average to be a much lower number in terms of what you multiply by, and here's why. If it's increasing fast like this is, you want to be able to multiply by a bigger number. Now this is getting confusing. How do I explain this in layman's terms?
Let's do this. Slow it down a bit now. We normally multiply by 20 because we want our price to free cash flow less than 20.
Right, but the reason we multiply by 20 is I want to I like taking an average of the last 5 years because I want to smooth out fluctuations. Not all companies are going to have consistent cash flow like this. And if they don't have consistent cash flow, that doesn't mean they're a bad company.
Yes.
What I want to do is take that metric. Let's say, for example, I wanted this metric to be the last year being under 15. So we take 2.2 times 15, 33 billion. Instead, though, because the last 5 years started at a much lower number, I'm willing to pay a bigger premium because now the average is lower than the previous year. Last year was 2.2, the average was 1.8, right? So I want I want to be able to multiply by a bigger number to kind of sit there and say, listen, I'm willing to pay a bigger premium for more consistent average lumps being smoothed out. If this had been 4 billion for some reason, that would make today's price look a lot. If it was some obscure reason why it was 4 billion, we want to smooth it all out. So when you smooth something out, I want to multiply by a much bigger number to kind of factor in that smoothing process.
So in the end,
I still think 20 times free cash flow is probably pretty good. Now, I don't know. I have an Excel sheet that I've created that runs these companies in my analysis, and it does make sense based on where they are that it would need to basically fall in half. This company, so it's at 36 billion right now. We have the company where the company's currently selling for about 60 billion. Okay, so the company needs to fall basically by 40% essentially for us to really justify buying it. But the great news is, guys, so this is a check mark and this is an X. But the great news about the company is when this company's price does fall, which it eventually will, stocks don't go up forever, and there certain things go in and out of love and all these things and et cetera, you'll be able to buy a really great finance company. Because usually what happens is this will keep going up, but people get bored of it because, hey, they paid $15 a share for it, now it's down to 10, even though it makes sense at 10, they'll get upset with it, and the price might go to 7 or 6. So that's why we look at the financials. We want to make sure the financials tell a better story than the price of the company relative to the value. So
going back to the price, what would you like to, sort of the take home is what would you like to buy this at?
So now I want to buy the company for around $35 billion. It's at 63 right now, which means if the current share price is 14, I want to pay $8 or $9 a share for it.
And when was the last time that happened?
When was the last time that happened? Within the last year, in the market fall of April.
Wow. Okay.
It was below 750.
Shall we look at momentum before we close out?
Absolutely. So now, guys, what we're doing here with momentum is...
Go ahead, Paul. Make sure you're smashing that like button, pretty please. We love you guys. Love it.
And the other reason I like doing this is I want everybody to look at fundamentals, and I also buy momentum now. Momentum is basically just, I'm going to sit there and look at where the stock is going. Does it have potential? There are certain indicators, and we're going to have Trader Mo on at times to discuss more technical analysis. But one of the things I look at, guys, is...
So right off the bat, to a normal viewer, this looks pretty confusing, Paul. Let's walk it out for us.
Okay, so the blue line is the 50-day moving average. The yellow line, orange line, is the 200-day moving average. When the 50-day goes above the 200-day, like it did right here, that is a bullish sign that the stock could go higher. If you had bought at this point, you would be buying at roughly $12.75 or so. And the stock is currently at $15. So this would have been an upward momentum, and you can also see that it's splitting apart even further. So the momentum is building, okay? Now, one thing I don't like in this chart that a lot of technical analysis people will talk about is this right here. It's called the gap. They would sit there and say this stock should eventually fill in this gap. I'm not saying they're right or wrong, but it's something to look for. But as you can tell back here, the stock went in fluctuation of crossing below, crossing above, crossing below, crossing above. If you trade this way over long periods of time, we have run back tests over 20 years, it beats the market. But what you have to be ready for is you will be wrong about 70% of the time. But the time you're right, it'll really go up a lot and you'll make a lot of money. So you'll have a lot of losses, a lot of small losses. Put your what's called stop loss in there, pick an amount of money, pick a percentage you always stick to, stay disciplined, like 5%. And if you lose 5%, you exit and wait for the next buy signal. And then keep going.
Infosys is an exciting company. A fan of ours during one of our live streams brought this up, and we looked at it. So keep your eye out for it. Paul will be keeping his eye out as well. And as always, keep your eye out for our live streams Tuesdays and Thursdays at 1 p.m.
Did you hit
Eastern.
record?
Yeah, we're great. Tuesdays and Thursdays, 1 p.m. 1 p.m. Eastern. Standard Eastern time in the U.S. Paul and I will be going live, taking your questions. And so... Paul, great job today.
Thank you very much.
See ya.